£1,163. That is the average amount of overpaid tax that HMRC refunded to individual pensioners last year after discovering, usually months or sometimes years after the fact, that the wrong amount had been taken from their income. £1,163 taken from people who did nothing wrong, applied to them automatically through a system that gets it wrong far more often than HMRC will ever publicly admit, and quietly paid back only when someone noticed the error or filed the right form. £1,163 that many retired people in this country never get back at all because nobody tells them they have overpaid, nobody tells them which form to file, and after 4 years, the right to claim it disappears permanently. If you were born before 1971, you are now at or approaching the age where the UK tax system starts treating you very differently from the way it treated you when you were working. Your income comes from different places. Your tax is collected in different ways. Your allowances, your thresholds, and your obligations have all shifted. And over the last 12 months, 5 specific rules have changed or tightened in ways that directly affect how much money leaves your pocket every single month. Not one of those changes was explained to you in a letter from HMRC. Not one of them was announced on the evening news. And not one of them will correct itself if you do nothing about it. I'm Elliot. Over the next 20 minutes, I'm going to walk you through all 5 of those rules, explain in plain English what each one means for your money, and tell you exactly what you need to do about each one starting today. Every single step is free. Every single form is available online. And every month you leave this unchecked is a month of money you may never see again. We start here because this is the rule that takes the most money from the most people in the shortest amount of time, and the one that the fewest pensioners know they can fix. When you take money out of a defined contribution pension for the first time, whether that is a lump sum, a drawdown payment, or cashing the whole thing in, your pension provider is required to deduct income tax before the money reaches your bank account. That part is normal. What is not normal, and what catches tens of thousands of retired people every single year, is how much tax they deduct. The pension provider does not know your full tax picture. They do not know what other income you have, what your total earnings for the year look like, or where you sit in the tax bands. So instead of applying the correct rate, they apply what is called an emergency tax code. And the emergency tax code does something extraordinary. It takes the amount you are withdrawing and assumes you are going to withdraw that same amount every single month for the rest of the tax year. If you take out £10,000 as a one-off lump sum in September, the system calculates your tax as though you are taking out £10,000 every month, £120,000 a year, and it taxes you accordingly. The result is that a basic rate taxpayer who should be paying 20% on a portion of that withdrawal can find themselves paying 40% or more on the entire amount. The money that is overtaxed does not disappear. It sits with HMRC, and HMRC will eventually correct the error and issue a refund. But that automatic correction does not happen until after the end of the tax year, and even then it can take up to 12 months. If you took a pension withdrawal in April 2026, you might not see the correction until March 2027. That is your money sitting in a government account, doing nothing for you for the best part of a year. You do not have to wait. There are 3 specific forms, all available on gov.uk, that allow you to reclaim the overpaid tax within weeks rather than months. If you took a partial withdrawal and you are not planning further withdrawals in the same tax year, you use a form called P55. If you cashed in your entire pension and have no other taxable income, you use a form called P50Z. If you cashed in your entire pension but you do have other taxable income from employment or another pension, you use P53Z. All 3 can be submitted online through your personal tax account on gov.uk, and HMRC typically processes the refund within 2 to 4 weeks of receiving the form. The amounts involved are not small. A pensioner who withdraws £20,000 from their pension pot and gets emergency taxed at 40% instead of the correct 20% has overpaid by roughly £2,000 in a single transaction. That is £2,000 sitting with HMRC that could be back in your bank account within a fortnight if you file the right form. And the form itself takes less than 20 minutes to complete. If you have taken any money out of a pension pot this year or in the last year and you did not file one of those 3 forms, go to gov.uk and search P55 Pension Tax Refund. The system will guide you to the right form for your situation. This is the rule that affects the highest number of pensioners in the country, and it is the one that creates the widest gap between what you should be paying and what you actually are paying, month after month, for years at a time. When you were working, your tax code was straightforward. Your employer received it from HMRC, applied it to your wages, and the right amount of tax came off your pay automatically. In most cases, it worked perfectly because you had one employer, one income, and one code. The system was built for exactly that situation. In retirement, the system falls apart. You now have 2, 3, sometimes 4 different sources of income. You have your state pension, which is paid to you in full with no tax deducted. You have a workplace pension, or perhaps 2 workplace pensions from different jobs, each deducting tax through PAYE. You may have savings interest, or rental income, or a small amount of part-time earnings. HMRC has to work out the correct tax across all of those sources and then tell each pension provider how much to deduct. It does this by adjusting your tax code on your workplace pension to account for the tax owed on your state pension as well. Here is where it goes wrong. The state pension for 2026 is £12,547 a year. The personal allowance, the amount you can earn before paying any tax, is £12,570. That is a gap of £23. £23 between your entire state pension being tax-free and your entire state pension being pulled into the tax system. If you have even a tiny workplace pension on top, £100 a month, £50 a month, you are over the threshold and you owe income tax. HMRC handles this by reducing the tax code on your workplace pension. Instead of getting the full £12,570 personal allowance applied to your workplace pension, you get only what is left over after the state pension has been accounted for. In practice, that means your workplace pension provider may be told to deduct tax as though almost all of your workplace income is taxable. And if HMRC gets the calculation even slightly wrong, which it frequently does because the state pension amount changes every April with the triple lock, your workplace pension provider deducts too much or too little, and you either overpay for months without realizing, or you receive an unexpected bill at the end of the year. The fix is simple, and it costs you nothing. Log into your personal tax account on gov.uk. Look at the tax code that is currently applied to each of your income sources. If anything looks unfamiliar, if there is an old employer still listed, if a benefit adjustment you do not recognize has been added, if the numbers simply do not match what you know you are earning, call HMRC on 03002003300 and ask them to walk you through it line by line. If the code is wrong, they will correct it, and if you have been overpaying as a result, they will issue a refund for the current tax year and potentially for previous years as well. You have 4 years to reclaim overpaid tax. After that, it is gone for good. I would go further and say this. Every single pensioner watching this video should check their tax code at least once a year, every April, when the new tax year begins and the state pension amount changes. That one check, which takes less than 15 minutes, catches problems in weeks rather than years. This is not a new rule. Marriage allowance has existed since 2015. But it appears in this video because 2 things about it changed recently that make it more urgent for pensioners in 2026 than it has ever been before. The first change is arithmetic. Because the personal allowance has been frozen at £12,570 since 2021, and because the state pension has risen every year since then, more and more retired couples now find themselves in exactly the position where marriage allowance applies. One partner earns less than the personal allowance. The other earns slightly above it. This is the textbook eligibility scenario, and the frozen threshold means it catches a bigger group of pensioners every single year. The second change is the backdating window. Marriage allowance can be backdated for 4 tax years. Every April, the oldest year drops off the end and is lost permanently. As of June 2026, you can still backdate to the 2022/23 tax year, giving you up to roughly £1,000 in a single backdated payment. Wait another 10 months, and the 2022/23 year disappears. Another £252 gone forever. Here is how it works. If one of you earns less than £12,570 a year, which includes many pensioners whose only income is the state pension, and the other pays tax at the basic rate, the lower earner can transfer £1,260 of their personal allowance to the higher earner. That reduces the higher earner's tax bill by £252 a year. It is not a fortune on its own, but it is £252 a year for doing nothing more than filling in a form that takes 15 minutes. You apply for free at gov.uk/marriage-allowance. Do not, under any circumstances, use a paid claims company. There are dozens of them advertising online, promising to handle your marriage allowance claim for you, and every one of them charges between 30% and 40% of your refund for a form that you can complete yourself while the kettle boils. The form is on gov.uk. It is free. It takes 15 minutes. Save yourself the fee. One more thing that almost nobody mentions. If your husband or wife has died since April 2016, you can still claim marriage allowance for the years you were together, provided the eligibility conditions were met. You do that by calling HMRC on 03002003300. The money is paid to the surviving partner. And if either of you was born before the 6th of April 1935, you do not qualify for marriage allowance, but you may qualify instead for something called married couples allowance, which is actually worth more, between £453 and £1,170 a year. Check gov.uk or ask HMRC when you call. This is the newest rule on the list, and it is the one that caught millions of pensioners off guard when it landed. Because for 27 years, the winter fuel payment was a simple, universal benefit. Everyone over state pension age received it. No questions asked, no conditions, no clawback. That changed. For winter 2024/25, the government restricted the payment to pensioners on pension credit or other qualifying benefits, cutting roughly 10 million people off overnight. After an enormous public backlash, the government reversed course for 2025/26 and reinstated the payment for all pensioners. But it added a new mechanism. If your individual taxable income is above £35,000, HMRC will claw the entire payment back through your tax code. The payment itself is £200 per household, or £300 if someone in the household is 80 or over. The clawback threshold is £35,000 of taxable income, which means your gross income before deductions, but after pension contributions. And the threshold is a cliff edge, not a taper. If your income is £35,000, you keep every penny. If your income is £35,001, you lose the entire payment. There is no sliding scale. For most pensioners, this does not matter, because most pensioners earn well below $35,000. But for those near the line, it matters a great deal, because the definition of taxable income includes things you might not expect. Your state pension counts. Your workplace pension counts. Savings interest above your personal savings allowance counts. Rental income counts. Even the proceeds from selling a buy-to-let property or cashing in a pension pot could push you over the threshold in that particular year. If you are anywhere near that £35,000 mark, the single most useful thing you can do is check your projected total income for the 2025/26 tax year, which is the year the clawback applies to. Your personal tax account on gov.uk will show you an estimate. If you are over the line, you can expect HMRC to adjust your tax code for 2026/27 to recover the amount. If you are under the line, the payment is yours to keep and no action is needed. The genuinely important thing for pensioners to understand about this rule is that it makes your annual tax position more complicated than it used to be, and it makes checking your tax code even more critical than it already was. A pension withdrawal, a one-off freelance payment, or a chunk of savings interest that tips you over $35,000 even once can trigger a clawback you were not expecting. The system will not warn you in advance. It will simply adjust your code and take the money. The final rule is not a new change. It is the cumulative effect of all the others, and it is the one that puts the most money back into the most pockets, provided you actually check. HMRC runs a system called P800 reconciliation. At the end of every tax year, their computers compare what you actually earned across all your income sources against what tax was collected. And if there is a mismatch, they issue a notice. If you overpaid, the P800 tells you how much you are owed and offers you a refund. If you underpaid, it tells you how much you owe and either adjusts your tax code for the following year or asks for a one-off payment. The problem is that the P800 system does not catch everything. It relies on information that HMRC receives from pension providers, employers, and banks. And if any of that information is late, incomplete, or simply wrong, the reconciliation misses the error entirely. The pensioner never receives a P800 letter, never finds out they overpaid, and the money sits with HMRC indefinitely. You have 4 years to claim a refund for overpaid tax. After 4 years, the right to reclaim expires. So if you overpaid tax in the 2022/23 tax year and you have not yet received a refund or a P800 letter, you still have until the 5th of April 2027 to claim it. But if you overpaid in 2021/22, that window has already closed. Every year that passes without you checking is a year of potential refund that becomes permanently unreachable. The reasons pensioners overpay are remarkably consistent. The most common is a wrong tax code, which we have already discussed. The second most common is bereavement. When a spouse dies, the surviving partner's tax situation changes immediately, often in complex ways, particularly if the couple had been splitting income across 2 personal allowances. The payee system does not always adjust quickly enough, and the surviving partner can spend months or even years being taxed as though the old arrangements are still in place. The third most common is retirement itself. A person who retires in the middle of the tax year has often been taxed by their employer as though they were going to earn a full year's salary. Once they stop working, the tax already deducted may be far more than the tax actually owed. The refund is there for the taking, but only if someone files the claim. Go to gov.uk and log into your personal tax account. Check whether you have any P800 letters waiting. Check whether your income and tax figures for the last 4 years match what you know to be true. If anything looks wrong, and it often does, call HMRC and ask for a review. The refund, when it comes, is usually paid within 6 to 8 weeks. Why the system relies on you. Here is what ties all 5 of these rules together, and it is the same message whether we are talking about emergency tax on a pension, a wrong tax code, marriage allowance, the winter fuel clawback, or a 4-year-old refund sitting unclaimed in an HMRC account. The system is passive. It does not chase you. It does not send reminders. It does not tap you on the shoulder when it overcharges you, and it does not write to you when you are entitled to something you have not claimed. The obligation sits entirely with you, the retired person, to know what you are owed, to file the right form, and to check the numbers yourself. And if you do not, the money stays exactly where it is, in the system, untouched, until the window to claim it closes and it becomes permanently unreachable. That is not how most pensioners expect the tax system to work. Most retired people in this country assume that HMRC, whatever its faults, at least gets the basic arithmetic right. They assume that if they were overcharged, somebody at HMRC would notice. They assume that if a new allowance applied to them, it would be applied automatically. And they assume that the tax code on their pension must be correct, because surely a government department would not send the wrong number to a pension provider and let it sit there uncorrected for years. Every one of those assumptions is wrong. And every one of them costs ordinary retired people real money every single month for as long as the error goes unchecked. If you do one thing after watching this video, let it be this. Log into your personal tax account on gov.uk. Look at your tax code. Look at your income summary. Look at whether you have a P800 notice waiting. And if anything does not match what you know to be true, or if you simply cannot make sense of the numbers, call HMRC on 0300-200-3300 and ask them to explain it. The call is the difference between leaving hundreds or thousands of pounds in the system and getting it back where it belongs, which is in your bank account. And if there is someone in your life, a parent, a widowed aunt, a neighbor who lives alone, who is over state pension age and unlikely to log into a government website unprompted, please sit down with them and help them check. The forms are free, the phone line is free, and the money, in almost every case, is already theirs. The only thing missing is the 15 minutes it takes to ask the right question. I'm Elliot. I sit down with the ordinary rules that decide how your money is taxed, collected, and sometimes quietly kept by the system when it should have been returned to you. And I explain them in plain English so that retired people can stop losing money they never needed to lose. Check the code, file the form, and keep what is yours. I'll see you in the next video.